Hi, this is lesson 3. We're going over closing costs and estimating closing costs. Just like in lessons 1 and 2, this is a hands-on exercise where you're going to actually calculate closing costs instead of just getting an answer like it's 2 to 3% or something like that where you find online. What I want to show you is how to actually calculate closing costs. We can't get to an exact number, but we can get close. And then you better understand a transaction when you get down the road. Just to give an overview, lesson 1 was about the components of a mortgage payment. We calculated principal and interest, property tax, homeowners insurance, hazard insurance, and monthly mortgage insurance. Gave you background on all those things. Lesson 2, we went more into specific loan types, how they influence how much you need down, how mortgage insurance cost changes based on loan type and the amount down. Now we're in lesson 3 and we're going to be estimating closing costs. So a lot of the data from lesson 2 is imported into lesson 3. Just like the other sections, you only enter information in the green boxes. So we're going to start out going back to the second tab, which was loan types, just to go over what we're putting. So we're putting $600,000 for the purchase price in this case, but you can enter whatever your actual purchase price is. In this case, we're using FHA. In my example, if you watch lesson 2, you can see the reasons why to pick one or the other, but you can pick whatever you want. In this case, we're doing 3.5% down. We're using a rate of 5.75 and a 30-year term. And you can see that's all auto-populated here into lesson 3 for calculating closing costs. So now we're going to get into what we need to enter, what those things mean, and how they influence closing costs. Start out with discount points. So discount points are what you pay to reduce the interest rate up front. You don't need to pay discount points, but so the easiest way for me to explain this is just to go on our website, speakstraightmortgage.com. We give live rates. So, and we give the cost in points. So it's easy to calculate. So we have this 9. Okay, so we put the information in the pricer. Purchase price of $600, loan amount of $579, which is 3.5% down. Hit get rates. You can see now it comes up with rates and points, and I'll show you what you need to enter. So in this first column, we can see rate. In every rate, you go 2 columns down, has the cost in points. You can see you could do 6.25 and it doesn't cost you anything because it's a negative. You actually get money back to take that amount. But in this case, we're using 5.75. So we take 5.75, we look at the points, which is 1.125. We go back to discount points and we enter 1.125 here. I've already done it, but you'd enter that here. So 1 discount point is 1% of the loan amount. In other words, if the total loan amount's $589,000, it would be $5,890 is 1%. That's what 1 discount point would be. But you don't need to remember the formula because it's going to auto-calculate it for you. So when you enter 1.125, it's taking that times the total loan amount and giving you the cost in discount points in section A. So I have a separate video going over what a loan estimate looks like. This closing cost worksheet is being expressed in the way a loan estimate looks. And that is for a purpose, because if I just showed this to you in a way that was the easiest to read, when you got to a loan estimate, you'd be like, what's going on? So it's best to just format it like this now, because you're going to need to understand it this way anyway. So on a loan estimate, which I'll show you where you can see what a loan looks like, even though I've got to have a separate video on that. But if you go to CFPB Loan Estimate Explainer, CFPB is Consumer Financial Protection Bureau, you can see it gives you a detailed breakdown of a loan estimate. And on a loan estimate, this is what a lender gives you when you go under contract, or further down in the loan process, you will get a loan estimate. And if you look on page 2 of the loan estimate section, there's a section A, B, C, D, E, F, G, H, I, J, and a total cash to close. That's what I have this. That's why I have this formatted in the same way, same section, same information. So section A, we enter discount points and auto-calculated down here. Lender fees. At Speak Straight Mortgage, we don't have any lender fees on the vast majority of our loan programs. There's some down payment assistance programs that we have to charge lender fees, but for the most part, we don't charge lender fees. So if you're trying to calculate what we charge for closing costs, you could put 0 here. Now, that can range a good deal between lenders. Like from, I would say average, probably $1,500, but it can go up from there. Anyway, for this purpose, I can let you know that we don't charge any lender fees. We have the cost of points that you can look up at any time, because our rates are live, so it's going to be fairly accurate. Okay, so now we have section A calculated, because we put lender fees as 0 because we don't charge any lender fees. Okay, next thing you need to enter, homeowners insurance. So if you go back to section 2, you remember section 2, we have this auto calculating an estimate of homeowners insurance. If you don't have an actual quote, you can just use this number, which is $3,300. It's calculating it's calculating 0.55% of the purchase price, which is usually fairly close. Homeowners insurance has gotten a lot more expensive in the last year, but anyway, so you could enter 3,300 from lesson 2. If you have an exact number, if you have a real quote, you can put it there. And I will show you how that impacts closing costs when we're going through each section. Okay, days from the end of the month, from closing to the end of the month. So when you close at the end of the month, there's less closing cost than when you close in the beginning. That's because you're paying interest from the day you close to the first day of the next month. That is because, let's say you close on November 5th, you don't have a payment due December 1st. The first payment is due January 1st. So you're paying interest, even though you're skipping the payment, you're still paying the interest over that time. It's just paid at closing. So you can tell the difference. When I have 1 day in here, you can see prepaid interest in section F is only $93. If I change this to being the first day of the month, you can see that went up to $2,800. Okay, next column, property tax. That's auto importing from whatever you put in lesson 2. And again, lesson 2 goes over where to find that per property. Okay, next section, seller concessions. So seller concessions, this is one of the reasons why you want to talk to a lender and a real estate agent early. You can get a substantially better deal in most cases when you have seller concessions. That basically means, like, let's say you put in an offer on a house that costs $500,000. You can ask the seller, say, okay, Mr. Seller, I'll give you your full offer price, but I want you to give me back $5,000 at closing to help pay my closing costs. And there's a lot of great things you can do with that. to get a better deal. And I'll have a separate video going over that, but we'll put 0 here for now. For that, lender credits. When we were looking at interest rates, you can see this as a negative number. So that's 500. That equals to $507 lender credits. So it's possible you can get lender credits by taking a higher rate. If you had lender credits, that's where you would put there. Right now in 2024, it's difficult to get lender credits because everybody's expecting rates to go down. So lenders don't want to incentivize you to take a higher rate when they know that you're going to refinance it. Okay, so next is processing fee. Some lenders charge a processing fee in Section B. We don't charge any processing fee at Speak Straight Mortgage, so I'm putting 0. If somebody did, that can range from anywhere from probably $200 to $1,000. Average probably be $700. Okay, next box, earnest money. So when you put a house under contract, there's a deposit you need to make to basically hold the property. Usually that's 1% of the loan amount. If you wanted to, you could enter that because it comes off the cash to close. It's a deposit you make, but it comes off of what you owe in the end. I'm going to leave it 0 now. If you wanted to, you could enter that. Okay, miscellaneous fees. An example of miscellaneous fees are, let's say you bought a condo or a townhouse and there's an HOA transfer fee, there's HOA reserves required. New construction has different types of fees sometimes. I'm leaving that 0. If you have a condo or a townhouse, I would put $1,000 in there just to be safe because of those fees I just mentioned. Like there could be condo certification fee, which I would actually go in Section B, but you could put it in H. It's going to have the end result's going to be the same. But we're putting 0 there. Miscellaneous credits. This could be something like real estate agent credits. We're leaving it 0. Okay, now we're going to go over. So this is the only things we needed to enter, assuming we entered everything in lesson 2. Now we're going to go over how these numbers impacted cash to close, or the amount out of pocket you need. So Section A, again, we put 0 for lender fees, discount cost was the points we entered. Section B, this is third-party fees. A lender cannot increase third-party fees. In other words, one lender can't say, I'm getting the appraisal for $500, but I'm going to charge the customer $700. You can't do that. You get charged exactly what they are. So when comparing, if your purpose is comparing lenders, Section B is going to be very close. The only thing to look out for is that some places charge a processing fee, which could be from $300 to $1,000. I would say an average $700 in this section. That's where we would have put this here. At Speak Straight Mortgage, we don't charge a processing fee, so I'm leaving that empty. Appraisal fee. So appraisal is when you put a house under contract, the lender needs to send somebody to the property to see how much it's worth, because they can only lend to what it's worth, or a factor of what it's worth. And that's auto-populating. Credit report fee. Credit reports are getting more expensive. I put $75 here. And MERS and flood cert are common lender fees that are in Section B. Okay, something to be aware of that we went over in Section 2. FHA MIP or VA funding fee. You can also put USDA here. You can see this is $10,133. If you remember back to lesson 2, when we picked FHA has a 1.75% funding fee that's added to the loan amount. So you can see it's added here, but it is itemized here. You don't pay this out of pocket. because you can see on this final cash to close, it's financed. It's added to the loan, but it's itemized here. If this was not an FHA loan, let's say this is conventional, and we go back to lesson 2 to change this to conventional, and change this to 5% down, you can see the funding fee goes away because conventional loans don't have a funding fee. Or, upfront MIP fee is what you call it for FHA. Funding fee is what you call it for VA. And guarantee fee is what you call it for USDA. But they're all an upfront fee that would be listed right here. But we're going to go back and put it back as FHA, put it back as 3.5. And that will change everything here. So that's section B. Section C are title company fees. On a purchase, the seller chooses the title company in Colorado in every case I've ever had in my career. Even though it says services the buyer did shop for, on a purchase, the buyer never shops for it. I don't know why they say it that way. But $1,300 should cover the cost of Section C fees. They might be itemized in different titles, or they might use different descriptions, but generally lender's coverage and settlement or closing fee are the big part of those two. Section E are taxes and other government fees. So, okay, this column on this side are what they categorize this as loan costs, and the total of the loan costs comes here in Section D. They categorize this side as other costs. So Section E, state tax in Colorado, this is a percentage of the loan amount. It's auto-calculated. Recording fees for the deed and the mortgage are roughly $175. So this is a pretty close estimate of what this will be. Okay, Section F. Now when we entered homeowners insurance cost, this is how homeowners insurance influences closing costs. You pay homeowners insurance 12 months in advance when you close. Actually 14 if you're getting technical, but I'll go over that in the next section. So you pay upfront 12 months of mortgage insurance, and it comes out of the closing. So that's itemized here. Prepaid interest, remember when we showed that if we're closing the beginning of the month, this is more expensive. You can see that it's $28.77. If we closed at the end of the month, one day before the next month, you can see it is $93. So that influences out-of-pocket cost when you close in the month. Next section, initial escrow. When I was saying 14 months for homeowners insurance, that's because an initial 2 months is collected because you're always paying in advance, because escrow is basically an account that holds money to pay homeowners insurance and property tax out of your mortgage payment. It's always collecting money to pay it the next year. So an additional 2 months, in addition to the initial 12 months, are collected in escrow because you skip a month payment when you close on a house. Same thing with property tax. 2 months escrow is collected. This might say a different number on a loan estimate, but in the end, there's an adjustment and it will end up near 2 months. Section H is miscellaneous fees. Like we said, an example would be HOA reserves or HOA transfer fees. Leaving this zero. If you had a condo or townhouse, I would put 1,000 in miscellaneous fees. In section I is adding everything in this section. Section J is adding this side and this side to get total closing costs. If we had any lender credits from the rate or for any other reason, they would be here. It would be subtracted from the total here. Okay, now we're getting to how you calculate the cash to closer. This is actually what you need out of pocket. So total closing costs we got from here. Down payment is the 3.5% down that we put down. Earnest money, we're not counting it. If you had any, it would be there. It would just subtract from the total cash to close. Finance closing cost. This is that upfront fee they charge here, but it's added to the loan, and this is showing where it's added to the loan, but it's not coming out of pocket. Seller credits, if we had any, this would be subtracting off the total loan amounts. Adjustments and other credits. This would be an example, would be possibly real estate agent credits. Taxes paid by the seller is another one. But that's how we get to cash to close. So I hope this helps to give you hands-on application of determining what closing costs are. If you have any questions, email me, call me, do a Zoom call going over this. But they aren't exact, but they're close. They're closer than what you get when you look online and they just give you some generic statistic like 2% of the loan amount, because it really depends. Really depends on property taxes. It really depends on what your homeowners insurance is. Depends on lender fees. Depends on discount points. But at least this is a tool to get you close to what it'll actually cost. Hope you're having a great day. Hope you join me for more lessons.